Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 8, Financial Risk Management, Mitigation, and Financial Derivative Contracts. In this topic, we'll continue to use the IMM, Identify, Measure, Mitigate process for managing risk, and discuss mitigation strategies. We'll understand how we can use forward and option contracts to hedge risk, and we're going to also briefly value option using the Black-Scholes option pricing model. In this topic, we're going to continue the topic 7 model where we estimated the risks of operating a gold mine, specifically the Hoffman gold mine. So remember the IMM process. You identify the factors that affect the viability of your enterprise. You measure how the risks affect cash flows and profitability. You mitigate the risks, and we're going to talk about that today, either by accepting them, laying them off, hedging them, or holding capital. And also, an important aspect I haven't brought up before is once you've done all this, you need to communicate the risk to the equity holders and other stakeholders. So here's what we did last time with Hoffman. We determined that operating a gold mine, there are 4 primary risks that we identified. The gold price declining, low gold content in the ground, a long winter, which then reduces the amount of time you can mine, and increases in fuel prices, which increases the cost to operate our equipment. So we determined that, and then last lecture was all about identifying or measuring those exposures. So we did a base case point estimate and estimate the cash flows would be $63,000 with a net income of $118. And then we looked at worst case, best case, where everything goes wrong and everything goes right. Then we looked at a global boom, a global bust, and a long winter. These are environmental scenarios, and we made up some parameters. And now we have a range of what the earnings and cash flows are going to look like. We then looked at a couple of our factors. The gold appreciation is obviously the big factor. So we looked at what happened to revenues, net income, and free cash flows by changing gold appreciation from -20 to +20%. And then we did a 2-factor sensitivity analysis, taking the 2 of the big factors of gold content per ton of dirt and the price change, and got a range of free cash flows. We lastly did a break-even analysis. We said, well, what gold appreciation would make us unprofitable, or at least 0 free cash flows, and that was -17%. And we said we need to find at least 0.2 ounces gold content per ton, and diesel fuel can't appreciate by more than 102%. And lastly, we calculated earnings at risk on gold. So there's a 5%, or if we're 95% confident based on the volatility of gold, that earnings will not fall below 93% from our expected value. So that's a pretty good job of looking at measuring the risks. So let's talk about what Hoffman can do to mitigate the risk. The one thing they can do is they just choose to accept the risk. They can say, well, that some risks are immaterial. For example, fuel is probably too immaterial to worry about to mitigating. Or you can just say that some risks are just too costly to hedge. So it's just about there's some risks you're just going to accept the risk positions. Now you could lay off the risk. You can just say, well, if you're a portfolio, you liquidate your position. Or if you're a business, you just cease operations. So you can just say, well, the risks are too big. We're just not going to go to Alaska and dig for the gold. Another alternative in risk mitigation is you're not really affecting the risk. All you do is you hold capital to reduce the impact of risk. So if I look at our worst case scenario, is we lose $222,000 in cash. One hedging, or I guess risk mitigation technique, is just to make sure you have $222,000 in cash, capital. So if that worst case scenario occurs, your firm still has cash to operate. So you're maintaining the viability of your operation. Lastly, you can choose to hedge the risk. So to hedge the risk, we can use insurance contracts, derivative instruments, or just business solutions. For example, we can use insurance to hedge, say, equipment, the risk that equipment fails, or we can hedge our risk of health by getting health insurance. You can also do some business solutions. We can mitigate low gold content by just using core sample testing. So for example, if we know we need 0.2 ounces per ton, we can do a core sample on a field before we spend, say, a month clearing it and make sure that it has enough gold content. We can mitigate health risk by using safety procedures and requiring helmets. Another thing we can do is something that's called an inventory build. If we're worried about fuel prices, but we don't really want to get into a real complicated hedging strategy, we can just buy all the fuel we want today and store it in a big tank. That's called an inventory build. And that way we'll mitigate our exposure to the price of fuel. And lastly, we can use derivatives. So derivatives are contracts whose value is derived from the value of another thing. So we're going to talk about gold derivatives. So these are contracts whose value is derived from the price of gold. And we're going to look at forwards, options, and swaps. So let's talk about that. A forward contract is simply a contract. It's an obligation between two counterparties to buy or sell an asset at agreed upon price, time, quantity, quality, and location. So, for example, Todd Hoffman in their mind could call a few banks and ask for a contract. I want a firm contract to sell all my gold, so I'm estimating 337.5 ounces next year at a fixed price, and I'll deliver the gold to you next year. That would be a forward contract. Now, he is obligated to deliver the gold, and the counterparty, say a bank or some other institution, is obligated to buy the gold at the agreed upon price. Now, forward contracts generally have no upfront fees or costs. The contract has two counterparties. One of the parties would be the buyer of the commodity, and they pay the forward price. The other contract, is the seller, and the seller delivers the asset and receives the forward price. So in the contract, you just specify who is delivering the gold and who is buying the gold and what is the price. Now, that's a forward contract. It's just a contract to buy or sell, an obligation to buy or sell in the future where all the terms are set. Now, a swap contract, one way to think about it, it's simply a bundle of forward contracts. So you can have a forward contract to sell gold next month, say 100 ounces, next year, 100 ounces at agreed upon price. But you can have a swap that agrees to sell, say, 10 ounces a month for 12 months at a single price. So it's just a bundling of forward contracts. Lastly, an option contract gives the owner the right but not obligation to buy or sell an asset at a future date at an agreed upon price. Now, in an option contract, we don't call it the forward price, we call it the exercise price, the option exercise price, or the option strike price. And there are two options. There's a call option. The buyer of a call option has the right to buy the asset at the strike or exercise price. A put option is an option to sell the asset at the agreed upon price. And the big difference there is an option, you will have to pay an upfront price for that ability to walk away. So let's talk about this forward contract. Now, what we're going to do is we're going to set up a mythical miner here that expects to sell 100 ounces, or expects to mine 100 ounces of gold in 1 year. And they expect, and they enter into a forward contract to sell all their gold for $1,200 an ounce. All right, because she fears the price may decline. So what if she's worried the price may fall to $1,000. So the miner finds a financial institution or any institution that agrees to this contract, where they will sell 1,000. Well, the miner will sell 1,000 ounces to the counterparty at $1,200 an ounce in 1 year. Now, this is called a physical delivery contract here, where you're actually physically delivering 100 ounces and receiving $1,200 an ounce. So if you have a physical delivery contract, the miner at the maturity date of the contract, you say 1 year from today, they will deliver 100 ounces of gold and they will receive $1,200 per ounce. So the miner will receive $120,000. The long party promises to give them $120,000, so it looks like they're perfectly hedged. Now, there's a note up here. There is a certain hassle with this physical delivery. I have to go to a specific location or a specific date and deliver the asset. Now, you could set up the contract that it's simply a financial settlement. And what I'm going to show you, what that means is you don't actually deliver the gold. What you actually do is just set up a contract which one party pays the other based on the price of gold. So what if we just set up the contract that the payoff for the seller, the miner in this case, is whatever the forward price is, say $1,200, minus whatever the spot price turns out to be, say it does go down to $1,000 next year, times some quantity, 100 ounces. So we have a contract now in which there's no delivery of gold. It's just a Las Vegas style bet and the contract payoff is just $1,200 minus whatever gold prices turn out to be next year times 100. Now, what if gold prices do turn out to be $1,000? Now, the miner does the calculation. $1,200, the forward price that they agreed upon a year ago. They woke up, prices are selling for $1,000 times 100. The miner goes to their counterparty and says, hey, send me a check for $20,000. We didn't agree. We agreed. Now, if the price did go to, say, $1,400, the miner would have to send a check. So the miner now has a check for $20,000, and they just go and they sell their gold wherever they want. And again, I said the price is going to be $1,000, so they go to their local market or store where they sell gold, and they get their $100,000 or $1,000 an ounce, and they got their check of $20,000 from some institution or counterparty of the forward contract. Now, if I take the $100,000 they got for their gold when prices fell, and the $20,000 they got from the forward contract payoff, that's $120,000. So what's strange about forward contracts is you could structure them that there's actually no delivery of the commodity just by setting up for the long party, taking the forward price minus the spot times the quantity. The forward party is effectively hedged, and they will always receive $120,000 at the end of the year through a combination of the forward contract payoff and the price of gold. Let's take an extreme example. What if the price of gold goes to zero? Well, they're not going to get any money for their gold in the markets, but when they do their calculation, 1,200 minus 0 times 100, they'll make $120,000 from this contract. So even if gold goes to zero, they'll make $120,000. Let's take another extreme event. What if the price of gold doubles and it goes to, say, $2,400? All right, what they're going to do is they're going to sell their gold and make a lot of money. 100 ounces times 2,400, so they'll make $240,000 on their gold. But they're going to wind up writing a check to the counterparty, and when you net it out, they're going to wind up just making $120,000. Now let's talk about the counterparty. Who would want to buy gold at a fixed price? Well, it could be a jeweler, or it could be, say, Samsung that uses gold to make their phones. So in that case, they're worried about the price of gold going up. So they get the same. They're the counterparty. Now again, this is a zero-sum game. You know, one counterparty is selling the gold, the miner. Another counterparty, say a jeweler or Samsung, is buying the gold. So since it's a zero-sum game, we just swap these two payoffs and say it's the quantity times the spot price at maturity minus the forward price. So if the price of gold falls to $1,000, the jeweler has to write a check of $20,000 to the miner, and then they go out and buy cheap gold where they like to buy gold and pay $100,000. Bottom line is they know they are going to pay $120, and the miner knows they're going to get $120, even though they don't have a contract that calls for delivery. Now you can structure forward contracts to be physical settlement, or you can do it just using these payoff functions. Now, the reason why I showed the payoff functions is it doesn't, as far as modeling goes, it's easier to model the effects of owning a long forward contract because I can just write in this formula and it will give me the payoff, the value of my position, whether it's delivery or not, because I said it doesn't matter if it's delivery. So let's go ahead and put in this contract inside our model. Now I took the model, I put it in our start file, and we're going to show the proceeds of our forward contract right under the revenue row. So I made sure I added that extra row, and I made sure my expenses all add up and I get to the right EBITDA. So let's go to our model. So here's our model. Again, here's my unhedged position. These are my cash flows. I copied the unhedged down here. And I'm going to make the assumption that they're going to get a 1632. Todd Hoffman is negotiated that the expected spot price of gold next year is 1632. So they negotiated with the bank to get a 1632 forward price, and negotiated a quantity of 337.5. But they made it so it's a physical delivery, or I'm sorry, a financial settle contract. So it's just writing checks to each other, like I just explained. Now, how we write that is assuming Todd Hoffman put on this contract, we can model the effect of it by just adding a line under, say, revenues, and we'll assume that those derivative payoffs are taxable. So we're going to say that's equal to the forward price I'm going to anchor that, minus whatever the spot price turns out to be in every scenario, don't anchor that, times the negotiated quantity, anchor that. So, you know, if gold, in this case, we did negotiate a spot price, which is equal to the we negotiated a forward price that is the expected spot price. So there is no exchange if the gold stays at 1632. But if I copy that formula over, what you see is anytime gold goes down, any scenario where gold goes down, I get a check. And if gold goes up, I have to write a check. So what's happening is we're basically always just guaranteeing we get 1,632 ounces, $1,632 per gold for 337.5 ounces. Now, this is a weird scenario because some of these scenarios we don't actually get that much gold. So Todd's going to have to come up with some, we'll have to buy the gold in the market. But that's okay. This is modeling the fact that sometimes you don't have enough gold, so you have to buy the gold and deliver and either deliver to the counterparty or just get the payoff, which is just, again, the quantity times the forward price minus the expected spot. So now these are our scenarios. And if we look back at the old one, these are a little smoother. You can't really see this. These are a little smoother. The good times aren't as good and the bad times aren't as bad. However, what's interesting is look at our sensitivity analysis. No matter what happens to the price of gold, if only thing happening is the gold price changing, revenues are unchanged, net income's unchanged, free cash flow are unchanged. We've eliminated our exposure to gold. Now here I have an example where you have what's changing in both quantity and gold appreciation. So only the base case do the cash flows unchanged. This is the situation where you have more or less gold. But these are still smoother than they used to be. So what's interesting too is what if gold falls by 90%? I still get my revenue of 550. However, what if gold goes up by 90%? Well, things aren't that, I still only get 550. So I've eliminated my exposure to gold prices on my base case quantity. Also, my EAR and CAR, my earnings at risk will go to 0 because I no longer have a quantity of gold that's sensitive to gold price changes, the base case quantity. So in fact, my V goes to 0. So that's how we can use forward contracts to hedge the price of gold for someone that's trying to sell gold. So here they are on one screen. Here is my unhedged position. Notice gold prices are changing here, and you have different values of revenue and net income and free cash flow. Notice I'm looking at the hedged revenue, which is the revenue plus or minus the payoff of the forward contract. And you can see these are just a little bit smoother. It's hard to see that, but if you look at the numbers, the scenario is a little bit smoother. So this is what it would look like if we hedged gold. It would just get safer. The bad times aren't as bad and the good times aren't as good. So let's talk about an option contract. What if we get at the best of both worlds? What if we had the right to sell our gold at $1,632, but we can walk away? Well, in that case, you want a put option. An option contract gives the counterparty the right but not obligation to sell or buy an asset at a future date. Now, in options, we don't call it the forward price. We call it the exercise or strike price. And if you enter into a put option, which Hoffman wants to, or which what they need, is that's the option to sell an asset. A call option is an option to buy an asset at the strike or exercise price. Option buyers require an upfront payment. So they must pay an upfront payment. Let me make that change. So it says should buyers pay an upfront payment, and that's called the option cost or option premium. Now, sellers of commodities like gold miners would have to do a put option. Now, a jewelry firm or say Samsung that needs to buy gold would do a call option. Now, what's nice about these contracts is once you put them on and pay the option price or premium, You then choose whether or not you want to exercise the option and sell the gold at the strike price. So only if that strike price, that price you've negotiated, is greater than the price of gold when you go to sell it, at the maturity of the contract, only if that strike price is a better price would Todd Hoffman exercise his put option to sell the gold at the strike price. Otherwise, he just walks away and there's no payoff. And so same with Samsung. Samsung would have a contract. It wouldn't be with Todd Hoffman, but it would be with another institution that has a call option to buy gold. And it would only exercise if that strike price of that option is less than the price in the market at the maturity of the option. Now we can model the payoffs for this just like we modeled the forward payoffs. So remember, to model the payoff for Todd, he's going to enter into a call option to buy 337.5 ounces of gold at 1632, the strike price. And the bank tells him that that contract cost is $222.09 per ounce. So Todd today will spend $74,955 today to buy a put on 337.5 ounces with a strike of 1632. And now he has the option, but not obligation, to deliver the ounces at 1632. Hoffman will only exercise if prices are selling for less than 1632. And how we model that, it was we say, well, if that 1632 is greater than the spot, all right, that's when Todd will exercise and get this payoff, the strike minus the spot times the quantity. Otherwise, Todd walks away and the payoff is zero. However, he did still pay the premium. Now, how we model that for Todd Hoffman, for the seller of the gold that bought the put option, is we say he will get the maximum, the greater of either zero or the strike minus the spot price of maturity times the quantity. Now, this is a mathematical trick that if I just put this formula in, it'll notice that if the strike minus ST is negative, in other words, Todd would lose money by exercising, it just uses the zero. So, however, if the strike is greater than the spot price, that's when Todd will exercise and he gets the strike price minus the spot price times the quantity. Now for the total profit would be the total cost of the option plus that payoff. Now for Samsung, if you want to buy an asset and you get a call option, all you do is flip these two terms. It's the max of zero spot price minus strike price. Let's go ahead and put this formula in for Todd Hoffman. So I'm going to say that I'm going to use this row here again, except I'm going to have the put option profits. I'm going to first input the cost of the option, $222 an ounce times 337 ounces, plus the payoff of a forward, the maximum of zero, strike minus whatever the spot price turns out to be, times the quantity. So I'll go to my put option model, which is just the base case. And then under this formula, I'm going to put first pay for the option. That option cost $222 per ounce. Anchor that times 337 ounces. All right, so you're going to pay Oops, I got the wrong cell there. Hold on. So it's going to be equal to minus 222.09 times the ounces. I'm going to anchor both of those. So if nothing happens to gold, Todd just wasted $74,000 to buy this option. However, let's calculate the payoff of the option. That's just the cost. So we'll say the max of zero, because you can't lose money. So it's the maximum of zero versus the payoff, because if the payoff turns out to be negative, you walk away. So the payoff is the strike. Anchor that. Minus whatever gold prices turn out to be. In this case, it's 1632 or 960 or 2,200. I won't anchor that because I want to drag that across. Times my quantity I negotiated So again, this is a case where the option is not exercised. Here's an example where the option is exercised. If gold prices fall 40%, Todd has already lost his $74,000, but he's going to exercise the option to sell his gold at $1,632 an ounce. And if I copy that formula over, if gold prices go up, well, great. Todd sells his gold at $2,200 an ounce, but he lost that premium. So we can copy this across. So now this is modeling the fact that Todd now has a put option on gold at $1,632. And what you see is whenever gold prices go up, Todd just loses his premium. When gold prices go down, he gets paid. Now this is a case where the gold price went down, but not enough to actually break even on the option. Remember, he paid $222 per ounce for the option, so gold prices had to fall below about $1,400 to actually break even. So this is the case where it actually made money. So these are now our scenarios. Notice here, this is a little bit different payoff, right? Anytime gold falls below 1632, right? So 2% appreciation, Todd has guaranteed himself a minimum level of revenue, net income, and free cash flows. This is the worst case gold scenario, anytime gold price goes up or goes down. However, the nice thing versus a forward contract is if gold prices go up, Todd's revenue, income, and free cash flow go up. So if gold prices double, they go up 100%, Todd's a millionaire. If he had a forward contract, he'd be locked into the forward price. And if gold prices go down 100%, they go to zero, Todd still makes the same amount of profit. So this is a different exposure. You're going to have to pay up front to have this really nice exposure in which we've almost guaranteed a minimum level of revenue, net income, and free cash flows. But we do get to participate in the upside. And there's the two-factor sensitivity showing that. So this is how hedging looks like using a forward contract and an option contract, and how it affects your payoffs, your revenues and cash flows and net income versus an unhedged position. Now I would notice that these are just different, not necessarily better. Forward is zero risk as far as price risk. However, there's zero upside too. A put option it seems like the best of both worlds. I mean, if the price goes up, I make a lot of money. But if the price goes down, I'm worse than both these other scenarios because I wind up paying that $75,000 premium. Now, note on option pricing. In your formula or in your spreadsheet, I put a function. This is not built into Black-Scholes, or I'm sorry, it's called the Black-Scholes option pricing model. It's not built into Excel, but I added it to this worksheet. So this function called BS put and BS call are functions which I copied the formulas into VBA, and then you can just always run them from this worksheet. Now, the Black-Scholes model is developed by Black and Scholes, two finance researchers in, say, the 60s, I believe, and early 70s, with some help from Bob Merton. They worked a long time to figure out a model to price options, and this is the standard model that everyone uses, at least as a first approximation of what prices should be selling at. So this model, all you need to do is put the current price of gold today, the strike price of an option that you're going to negotiate, so 1632. Doesn't have to be the expected price, just whatever strike you want. Put in the maturity in 1 year. Put in the risk-free rate for 1 year. Dividend yield is 0, because this model is actually built for stocks, so we just put 0 in for dividend yield. And the last one is, what is the expected standard deviation of gold? And you put in the model and calculate BS put. And what you get is $222.09, and that's what I used. Now actually 35% is a really high standard deviation. If it were actually only 10% standard deviation, the put should be selling for $63.64. And the call, $63.96. And Todd, if you want to negotiate even maybe say a 1550 strike, and the volatility is 10%, you could use this model to estimate that that option, I believe, should only be selling for about $30 an ounce. So this is a standard model for pricing options called Black-Scholes. And the underlying assumption of this model is that the percentage change of the asset, in this case gold, is normally distributed. Now, if one of the exercises I give in this class or in this assignment is to model the hedging of fuel. And what you want to do in this case is, if you want to hedge the purchase of fuel, you'll either get a call option or do a long forward contract. And I would just basically have to change the formulas to act as if we've entered into these contracts. So here's our final model using our gold hedged scenarios. And in this topic, we've talked about risk mitigation. After we've identified our risk, measured it, we then can decide how to mitigate. Mitigating, we can either just accept it, lay it off, in other words, just cease operations, hold enough capital that if the risk goes against us, we will survive to play another day. Or we can choose the hedge. We can choose to hedge the risk with insurance or derivative instruments or business solutions. And what we did spend a long time talking about is how to use forward contracts. You can use a forward contract to guarantee a price of an asset, and you can use an option contract to guarantee, say, a minimum price of an asset. So in this topic, we use the IMM process and discuss mitigation strategies. We understand how forward and option contracts are used to hedge cash flow risk. We valued an option using Black-Scholes, and we did that by using our Hoffman model from the last topic.